If you still believe the 50, 30, or 20 rule is the ultimate money formula, this might be the most important money conversation you hear this year. Because what if the budgeting rule millions of Americans follow is silently slowing down their wealth? What if the rule that sounds responsible is actually outdated for today's economy? And what if there is a smarter, more flexible system that can help you build wealth faster without feeling guilty every month? Stay with me. Because by the end of this video, you will not only understand why the old rule feels harder in 2026, but you will also have a clear, practical framework you can start using immediately. If you care about real financial growth, not just surviving paycheck to paycheck, take 1 second right now to like this video and subscribe to Money Finance Insights. On this channel, we break down money strategies in simple, practical language for real people living in the real economy. Now let's get into it. The 50-30-20 rule is simple. 50% of your after-tax income goes to needs, 30% goes to wants, 20% goes to savings and investing. It sounds balanced, it feels clean, it gives structure, and for years, it worked reasonably well for many households. But here's the problem. The economy of today is not the economy of 10 years ago. Housing costs have increased sharply in many states. Mortgage rates are significantly higher than they were during the ultra-low rate era. Rent in major cities often consumes more than 35 or 40% of take-home pay. Healthcare premiums and deductibles continue to rise. Car insurance premiums have increased in many states. Groceries cost more than they did just a few years ago. So when someone earning a middle-income salary tries to force their needs into 50%, it often feels impossible. Let's make this real. Imagine someone bringing home $5,000 a month after taxes. Under the traditional rule, $2,500 goes to needs. But what if rent alone is $2,000? Add utilities, insurance, transportation, and minimum debt payments. You're easily over $3,000. Now your needs are 60%, not 50%. And that is not because you are irresponsible. It is because fixed formulas do not adjust to real-life pressures. When the math does not work, people start to feel like they are failing. They feel behind. They feel stressed. But maybe the problem is not you. Maybe the problem is the rigidity of the rule. Here's the first big shift you need to understand. Money management should be dynamic, not static. The 50-30-20 rule is static. It assumes a stable income. It assumes moderate cost of living. It assumes predictable expenses. But in 2026, many Americans work freelance, commission-based, remote, or gig economy jobs. Income fluctuates. Expenses fluctuate. A rigid percentage system struggles in a flexible economy. Now here is the deeper issue. The 50-30-20 rule focuses on balance. But wealth is rarely built through balance. Wealth is built through intentional imbalance toward investing and asset ownership. Think about this carefully. If you want average results, average allocation might work. But if you want financial independence, early retirement, or serious wealth growth, 20% savings may not be aggressive enough. Let me give you perspective. If someone invests 20% of their income consistently, they can build solid retirement savings over decades. But if someone invests 35 or 40% early in life, the compounding effect becomes dramatically more powerful. Compounding rewards those who prioritize investing early and heavily. The rule does not account for ambition, it only accounts for moderation. So what is the smarter way? The smarter way is goal-based allocation. Instead of starting with percentages, start with your target. Ask yourself this: what kind of life do I want in 10, 20, or 30 years? When do I want optional work instead of mandatory work? What number gives me peace of mind? Once you define that number, you work backwards. Let's say your goal is $2 million invested by age 60. You calculate how much you need to invest monthly to reasonably reach that goal, assuming long-term market returns. That number becomes your savings priority. Not 20%, not 25%, whatever the math requires. This is reverse engineering wealth. Now let me introduce a smarter, flexible structure you can use. Think in layers, not slices. Layer 1 is stability. Layer 2 is protection. Layer 3 is growth. Layer 4 is acceleration. Layer 1 means covering essential living expenses and building a small emergency cushion. If you are here, do not stress about perfect investing percentages. Focus on survival and reducing high interest debt. Layer 2 means building a full emergency fund of 3 to 6 months of expenses. You begin consistent retirement contributions. You start protecting your income with appropriate insurance. Layer 3 means systematic investing in diversified assets over the long term. This may include retirement accounts, index funds, or other long-term vehicles aligned with your risk tolerance. Layer 4 is acceleration. Here you increase your investing rate beyond the standard. You explore additional income streams. You focus on asset ownership that can produce income. Notice how this framework adapts to stage of life. A 24-year-old recent graduate should not follow the same percentage as a 45-year-old executive. Flexibility creates clarity. Clarity reduces stress. Another powerful shift is automation first. Instead of budgeting what is left after spending, automate investing immediately when income arrives. If your long-term goal requires one $1,500 monthly investment, automate that transfer. Then design lifestyle around what remains. This approach removes decision fatigue. It protects your future self before lifestyle expansion happens. Now let's talk about lifestyle inflation. Lifestyle inflation is subtle. You get a raise, you upgrade your car, you move into a bigger apartment. You increase subscriptions, you dine out more frequently. None of these feel extreme individually, but collectively, they prevent wealth from compounding. A smarter rule is this: when income increases, increase investing rate first. Then, allow a small lifestyle upgrade. For example, if you receive a 10% raise, direct 6% toward investing and allow 4% toward lifestyle. This creates forward momentum instead of stagnation. Now, I want to address something emotional. Many people hold on to the 50-30-20 rule because it feels safe. It feels like something responsible adults follow. It feels structured. But structure should support your goals, not limit them. If you temporarily reduce wants to 10% to eliminate debt faster, that is strategic, not extreme. If you raise investing to 40% because your income allows it, that is intentional, not unbalanced. Money is personal. It reflects your values. The old rule does not ask what you want from life. It simply divides money evenly. But what if you want freedom sooner? What if you want to help your family more? What if you want to build generational assets? Those goals require customization. Let's also talk about debt strategy. High-interest credit card debt often carries rates above 20%. Paying that off gives a guaranteed return equal to the interest rate avoided. In that scenario, aggressively paying down debt may be smarter than rigidly investing only 20%. Again, flexibility beats formula. For variable income earners, a baseline model works better. Calculate your lowest consistent monthly income over the past year. Build your essential lifestyle around that number. In higher earning months, aggressively save and invest the surplus. This smooths volatility. It reduces anxiety. It builds buffers. Now imagine this scenario 5 years from today. You consistently invested based on goals. You increased savings rate with raises. You avoided heavy lifestyle inflation. You built an emergency fund. You eliminated high interest debt. You would feel stable. You would feel confident. You would feel in control. That feeling is more powerful than following any fixed rule. Let me give you a simple practical plan you can apply this week. Step 1. Calculate your exact essential monthly expenses. Be honest and detailed. Step 2. Define your long-term wealth target and timeline. Step 3. Calculate the required monthly investment amount to realistically approach that goal. Step 4. Automate that amount immediately after income hits your account. Step 5. Design lifestyle spending from what remains. Review this plan annually. Adjust percentages as income changes. This is dynamic wealth management. At Money Finance Insights, our focus is not on memorizing rules. Our focus is on building systems that evolve with you. Before we close, I want you to reflect on something simple. Are you following a rule because it truly fits your goals or because it sounds responsible? There's nothing wrong with 50-30-20 as a starting point, but it should not become a ceiling. You deserve a system aligned with your ambition. If this video challenged your thinking, I want to hear from you. Are you currently using the 50-30-20 rule? Has it worked in your situation? Or does it feel unrealistic in today's economy? Share your experience in the comments below. Your story might inspire someone else to rethink their strategy. If you found value here, share this video with someone who is trying to improve their finances. Sometimes a small mindset shift creates a massive long-term impact. Remember this: rules are tools, not chains. Money is not about perfect percentages. It is about direction. It is about intention. It is about freedom. Your financial journey is not about fitting into a formula. It is about building a future that gives you options. Thank you for spending your time with Money Finance Insights. I truly appreciate every single one of you who watches until the end. Keep learning, keep adjusting, keep investing in your future self, and I will see you in the next video.